Welcome back to the Deep Dive. Today, we're tearing apart a recent earnings call transcript for DH. They're a company working in that complex world of government services.
Right. Always a fascinating sector to watch.
Definitely. Our goal, well, it's to cut straight to the chase. We're going to unpack their latest financial results, try and get inside management's head about what matters most right now.
And pull out the really important signals from their conversation.
Exactly. Think of this as your fast track, to understanding what actually happened in this specific earnings call.
And the context is interesting, isn't it? Government spending shifts, a new administration.
Yeah, navigating some choppy waters for sure. Management themselves called it a pretty noisy macro environment.
Okay.
So let's unpack the headlines from their fiscal 2025 second quarter results.
All right.
All right, so headline numbers. For Q2 fiscal 25, DH reported revenue of $89.2 million.
Okay.
And their EBITDA, that's earnings before interest, taxes, depreciation, and amortization, that came in at $9.4 million.
And the management felt this was in line.
Yeah, they said it was right in line with what they expected. And actually pretty much matched their first quarter results for both revenue and EBITDA. So some stability quarter over quarter, it seems.
Okay, what's fascinating here, though, is putting those figures into perspective, like comparing them to the same quarter last year, Q2 fiscal 24.
Right, the year over year. How does that look?
Well, revenue last year was quite a bit higher. It was $101 million.
Wow, okay.
And EBITDA was also higher at $10.2 million. So you definitely see a decrease year over year on both the top line and that EBITDA figure.
But the margin, did that move?
Yeah, and this is the interesting part. Their EBITDA margin actually saw a slight improvement. It nudged up from 10.1% last year to 10.5% this year.
Okay, so the margin story is positive, a little bit of efficiency there maybe, but revenue was clearly down compared to a year ago.
Yeah.
Let's dig into why. Why did that revenue number step back year over year? What did management say?
They were quite clear about this, actually. They did mention getting contributions from some recent contract wins and, generally steady business delivery timing.
Okay, some positives.
But the single biggest offset, the thing that essentially explains the entire decrease compared to last year, was the conversion of certain programs. These were within agencies like the VA, Veterans Affairs, and the DOD, Department of Defense.
Conversion to what?
Over to small business set-aside contracts. And they put a number on it, too.
Oh, really? How much?
They quantified the impact at approximately $11.8 million just in this quarter.
Wait, $11.8 million. Let me check the math. So last year was $101 million. This year, $89.2 million. Yeah. That's an $11.8 million difference.
Exactly. That one factor, the set-asides, explains the whole year-over-year revenue change. It's the dominant story for that comparison.
That's incredibly direct, a clear headwind.
It really is. And it's also worth noting, like you mentioned earlier, that sequentially comparing Q2 to Q1, the revenue was nearly flat, almost in line. And actually, within that, their technology services revenue grew sequentially. So yeah, the year over year looks tough because of the set-asides, but the quarter on quarter picture shows a bit more stability, maybe underlying strength in certain areas.
Got it. Makes sense. So the set-asides were the big story for the year over year revenue. But management seemed really pleased with something else this quarter: cash flow. And debt reduction. They really highlighted that.
They did. And, for good reason. This quarter saw really strong operating cash flow. They generated $14.5 million.
That's a big number.
Especially compared to last quarter, Q1, where they actually used cash. About $11.5 million went out, mostly because of some collection delays they ran into back then.
Okay, so a big swing on cash flow. What do they do with it?
Well, that strong cash generation let them make some serious progress on the balance sheet. They reduced their outstanding debt by a substantial $15.3 million just in this one quarter.
$15.3 million.
Yeah, which brought their total debt down to $151.7 million at the end of the quarter. And they even gave an update saying it's now closer to $146 million.
So they kept paying it down even after the quarter ended.
Seems like it. And if we connect this to the bigger picture, this strong cash performance means they've already made all their mandatory debt payments, the ones that were due all the way through March 2026.
Wait, March 2026, they're a year ahead.
A full year ahead of schedule on those mandatory payments. That's a major de-risking event for the company, you could argue.
Absolutely. Take some pressure off.
For sure. They also mentioned a positive amendment to their credit facility back in November 2024, which gives them a bit more financial flexibility. And management stressed that this whole delevering strategy puts them comfortably ahead of their debt covenants by about 80 basis points, they said.
Okay, so they're managing the debt well. What's the plan going forward? Keep paying it down?
Yeah, looks like it. They expect to use about 50% to 55% of their cash flow for the rest of the fiscal year, specifically for more debt paydown.
That's impressive balance sheet work. Definitely a bright spot in the quarter, like you said. Okay, moving beyond the hard numbers. Let's shift to how management sees the broader market, the government services world. You mentioned they used strong language, significant disruption, noisy macro environment. What's driving that noise, according to them?
Well, they talked about several external factors they're navigating. Part of it is still dealing with the fallout from actions taken by the previous administration.
Like what?
Specifically, the unbundling and rebidding of contracts into smaller pieces, often aimed at small businesses. They said the market's still kind of recovering from that churn.
Okay, legacy issues. What about the current environment?
On the slightly more positive side, they noted the March 2025 continuing resolution. That provides at least some stability for the FY25 budgets, which is helpful.
Right, avoids a shutdown scenario for now.
Exactly. And they're watching Congress closely, obviously, as they try to figure out longer-term spending priorities. Plus, they're analyzing the initial FY26 skinny budget request.
Right.
Trying to get hints about where the administration wants to focus spending next year.
So speaking of the new administration, how does DH feel their own capabilities, their focus, aligns with the stated priorities coming out of Washington now?
Management seemed pretty confident here. They laid out the administration's priorities as they see them. Things like promoting efficiency, cutting costs, ensuring accountability, lowering regulatory hurdles.
Kind of the standard efficiency drive language.
Pretty much. Basically, a push to streamline things, get stuff done faster, less red tape, lower price. They gave examples like modernizing health data systems, investing in healthy lifestyle programs, often paired with spending cuts elsewhere.
And DH thinks they fit into that.
They believe their advanced capabilities really position them well. They pointed to digital transformation, cybersecurity, systems engineering, integration, science R&D. They think these allow them to bid on the complex, high-value work that fits these priorities. And, importantly, lets them move up the margin scale.
So, higher value work, better margins.
That's the goal. They also said that despite all the macro uncertainty, they still see sustained demand for what they do. And, crucially, they've seen, quote, negligible impact from outright program terminations thus far.
Okay, so they feel their specific skill set is what the current administration is looking for. Modernization, tech-focused solutions.
That's certainly the message they conveyed. They see their sweet spot operating at that intersection of science and technology as highly relevant to the administration's goals: efficiency, modernization, advanced R&D.
Okay, here's where it gets particularly interesting. They highlighted specific capabilities and pointed to a key recent win. What can you tell us about that?
Yeah, they really emphasized the high demand they're seeing for their tech-powered solutions. And the notable win they called out was continuing their work with the US Army's Medical Research and Development Command, MRDC.
Okay, what kind of work is that?
Well, it's not just basic IT support. It involves pretty cutting-edge stuff. AI and machine learning AML, advanced modeling and simulation, robotics, complex engineering, clinical support, even biostatistics.
So really advanced R&D support.
Exactly. They framed it as delivering solutions right where science and technology meet, which, directly reinforces their core capabilities and their whole strategy of going after that higher margin, more complex work.
That sounds like they're definitely focusing on the more advanced, maybe stickier areas.
Yeah.
How does that translate into their overall business pipeline, their view on future growth?
They described the pipeline as very healthy, substantial, actually. They put a number on it, more than 4 times their annual revenue and qualified opportunities.
4 times. So if revenue is running around, $350 million annualized?
Right. So the pipeline is estimated at around $3.5 billion, spread across their different markets.
That's a big number.
It is. And they noted they've seen an increase in bid activity starting this quarter, Q3. They have a, quote, robust roster of opportunities they're chasing for the rest of the fiscal year. All this makes them feel highly encouraged about their prospects for winning new business.
And growth. Is that the priority?
They explicitly said driving organic growth is their #1 corporate priority.
Okay, a $3.5 billion pipeline against roughly $350 million in annual revenue. That's a significant multiple, like you said, over 10x roughly.
Yeah, it is. And management seems pretty bullish about converting a good chunk of that, especially given their focus on that high value, complex work they feel aligns with current priorities.
All right. So we've covered the results, the drivers, especially those set-asides, and the debt paydown and management's view of the market and their pipeline. Let's turn to the Q&A session. What does this all mean when we look at the questions analysts asked and how management responded? What extra insights did we get there?
Yeah, the Q&A was interesting. One topic that came up was the status of their remaining SEOP contracts. These are pretty significant legacy contracts for them.
Right. What's the latest there?
Management gave some more clarity. They expect the quarterly revenue run rate from the remaining SEOP locations to be somewhere in the $20 million to $25 million range for the rest of this fiscal year.
Okay. So providing a baseline.
Exactly. They specified they have 5 locations running through October 2025 and 1 through August 2025. And they feel this provides better revenue visibility than the sort of short-term arrangements they had previously.
And the rebids for that work. When are decisions expected?
That's the key question, isn't it? Management indicated that award decisions seem to be trending towards mid-fiscal year 2026, or possibly even later. It really depends on how the new administration shapes its procurement strategies for these types of services.
So still quite a ways out, potentially.
Seems so. And they also specifically tied this back to the set-aside issue. They reiterated that the $11.8 million impact we talked about earlier is directly related to trends they're seeing with SEOP and similar programs being rebid as small business set-asides.
Got it. Okay, what else came up? I think there was a question about NIH, right? The National Institutes of Health. Something about a study shutdown.
Yeah, an analyst asked about potential impacts, referencing a specific women's health study shutdown that had been in the news.
And was DH involved?
Management clarified, no, they were not involved in that particular study or contract, so no direct impact from that specific event.
Okay, but what about their broader NIH work?
They did discuss their general exposure at NIH. They noted the administration is reportedly taking a, quote, tough position on certain areas of grant-funded research, which is part of DH's business there.
So, potential headwinds from budget scrutiny.
Potentially. However, management's overall belief, looking at their whole portfolio and based on their discussions, is that the total budgetary impact for the company, including NIH, will likely remain neutral to slightly positive.
Interesting. Neutral to slightly positive despite the tough position on grants.
Yeah, they sort of commented on what they called the herky-jerky nature of some initial decisions under the new administration. They suggested some might be influenced by, political factors or maybe even programs flagged by AI review processes.
Okay.
But they also think some programs might get restored or less affected once maybe better context is applied regarding their scientific merit or importance. So overall, management thinks the specific programs they are connected to at NIH and elsewhere will likely see limited material impact from these budget reduction pushes.
Did they mention any specific political factors?
They neutrally reported, based on the transcript, that factors referred to as DEI and perceived political overhangs were mentioned as things influencing some initial program decisions they've observed in the broader market. But again, they expect their specific programs to be largely unaffected by that.
Okay,
Yeah.
Understood.
Yeah.
Reporting what was said. Now, given that the set-aside impact was such a big deal this quarter, driving that revenue decline, when does management think that specific pressure, both on revenue and the pipeline, will ease up?
Good question. They expect the pressure on their pipeline, meaning opportunities shifting to set-asides that they can't bid on that should probably run through the current quarter, Q3.
Okay, so still feeling it now on new bids.
Right. But they believe the direct revenue impact from the conversions that have already happened should largely settle out by Q4 of this fiscal year. So the worst of the year-over-year revenue hit from that should be behind them soon.
That makes sense. Did they mention any potential upside related to set-asides?
They did bring up a possibility. What if the current administration decides to halt some of the previous administration's unbundling or set-aside actions? Maybe because they don't align with the new goals.
Why would they do that?
Well, for example, if unbundling isn't actually leading to the desired efficiencies and cost efficiencies of keeping bundled contracts, as management put it, or, again, neutrally reporting the discussion from the call, if factors related to initiatives termed woke lead the current administration to reconsider or stop those previous actions.
So a potential reversal of some set-asides.
It's a potential upside scenario they mentioned, but focusing on their existing business, the main revenue impact from the set-asides they've already seen should mostly wash through by Q4.
Okay. Got it. There was also an update, I think, on that $76 million Navy award they won a while back. How's that progressing?
Yeah, they said that Navy award is progressing as planned. It wasn't like a switch flipped on day one. It's phasing in work over time, and they expect it to keep expanding.
What kind of work is it tied to?
It's linked to specific Navy programs and platforms. So things like ship schedules can influence the timing of activities, like system or software updates. They mentioned expecting the work in Norfolk, Virginia to start leveling off soon, but they see potential growth coming online in the San Diego area, maybe early in fiscal year 26.
So moving along, but the timing isn't perfectly linear.
That's right. And the exact timing for expansion also depends on government decisions about which contracting vehicles they use for specific task orders under that award. Typical government contracting stuff subject to external factors.
Fair enough. Now, speaking of government processes, one challenge management really seemed to highlight was procurement delays, things taking longer across the board. What's causing that?
They pointed to two main reasons for what they called things slipping to the right, meaning awards and funding taking longer than maybe expected.
Okay, reason one.
Increased administration oversight. They said political appointees seem to be taking more time to review procurements before they go out. That just slows down the whole commitment process.
Right. More layers of review. And reason two.
This one sounded significant. They pointed to substantial haircuts or, retirements among the contract administration staff within the customer agencies.
So fewer people on the government side to actually process the paperwork.
Exactly. Fewer contracting officers, fewer administrators. That reduction in staffing is slowing down all types of contract actions, not just new awards, but also things like funding releases for existing work.
Has that hurt DH directly?
They said they haven't been materially hurt by these delays yet, but they did acknowledge that some of their peers in the industry have been feeling it. Management hopes some new best practices might help mitigate this over time.
It creates a weird tension, doesn't it? Because they also mentioned the administration wants to simplify and shorten procurement cycles in the long run, consolidate things under GSA.
Exactly. That's the paradox they described. The long-term goal is speed and efficiency, maybe consolidation, especially for civilian agencies using vehicles like GSA. But the short-term reality seems to be more oversight and fewer resources, leading to slowdowns.
So the administration wants things faster eventually, but their actions right now, like the oversight and maybe resource cuts, are actually causing delays.
That's precisely the picture management painted based on what they're seeing today. It really raises a big question about how companies navigate this transition period. How will this play out and ultimately reshape government contracting in the next few years? It's clearly a key focus.
Okay, let's shift gears completely for a second here. What we're about to talk about is purely for thinking creatively, exploring possibilities based only on the information we've just gone through from this transcript.
Right. Keyword, only from the transcript.
Absolutely. This is not financial advice. Seriously, folks. Trading or investing based on speculative ideas is incredibly risky. You should never, ever do it based on something like this discussion. Consider this just a thought experiment. For illustration.
Got it. The big disclaimer.
The biggest. Okay, so we spent all this time dissecting the DH earnings call. We heard about the revenue drop, specifically tied to those set-asides.
But also that really strong debt paydown, way ahead of schedule.
Right, and the huge $3.5 billion pipeline they're chasing, management's confidence about aligning with the new administration's priorities.
And then the counterpoint, those very real, acknowledged procurement delays happening right now.
Exactly. So imagine someone, purely hypothetically, looking at all these pieces, ignoring all risk, which again, totally outrageous.
Okay.
And thinking, maybe the market is too focused on the negatives right now. The past set-aside impact, which management thinks largely washes out revenue-wise by Q4, and these current administrative slowdowns.
Focusing only on the known headwinds.
Yeah. And maybe, just maybe, they're underappreciating the potential positives, the tailwinds. So the outrageous but plausible idea, based only on this transcript, could be, well, a highly speculative bet.
How speculative?
Like maybe through way out of the money, long-dated call options, or just a really concentrated stock position. The bet. The DH's stock price sees a sharp, maybe near-term upward move.
Okay, purely hypothetical. And the rationale, again, strictly from the transcript.
The rationale would be something like this. That $11.8 million set-aside hit, it's quantified, it's understood, and management expects it to mostly fade from the revenue comparison by year-end, the debt paydown. It's massive, it's ahead of schedule, it provides real financial flexibility. The market might not be fully pricing in yet.
And the pipeline.
The $3.5 billion pipeline. 4 times revenue. And management said they're seeing increased bid activity now and are highly encouraged. So the what-if scenario is, what if that herky-jerky nature of admin decisions means one of those big awards, maybe $1 billion plus under review, actually hits sooner than expected, catches the market totally by surprise?
Or what if the administration does halt some of those unfavorable set-asides from the last admin?
Exactly. Maybe because they don't fit the current goals of efficiencies and cost efficiencies of keeping bundled, or because of those other factors management alluded to, like woke initiatives being reconsidered. The really outrageous part of this hypothetical bet is that it willfully ignores the real, acknowledged short-term delays and headwinds management talked about.
Right. It discounts the current friction.
Totally. It bets purely on the big pipeline converting fast, the debt story getting appreciated quickly, and maybe getting lucky with a surprise award or policy shift as those headwinds maybe ease faster than expected, or a tailwind hits unexpectedly.
Disclaimer. Okay, and let me jump in again here, just to be absolutely crystal clear. This is not financial advice, zero. This is purely a hypothetical, speculative thought experiment. It's based only on analyzing the information shared in this one specific earnings call transcript.
That's it.
Trading or investing involves significant risk. You could lose your principal. You should never make investment decisions based on speculative ideas like this little thought experiment we just ran through. This is strictly for entertainment and maybe illustrating how someone might interpret data points from the source material. It is not a recommendation of any kind, period.
Right. Purely hypothetical, based only on the transcript. Don't do this trade.
Please don't.
All right, so wrapping up our deep dive into the DH earnings call transcript, we covered quite a bit. The Q2 performance, that revenue impact from set-asides, but also that very strong cash flow and the big debt reduction.
Definitely a key positive, that balance sheet improvement.
For sure. We got management's perspective on navigating the current government services market, how they feel they align with the new administration's priorities, the strength of that pretty substantial pipeline.
And the flip side, the challenges and opportunities from the changing government procurement landscape, especially those delays they highlighted.
Yeah, extracting these key points, understanding the drivers behind the numbers, and hearing management's direct commentary, it really does help build a clearer picture, doesn't it? Both of the company and kind of the broader sector trends.
Absolutely. It connects the dots between the financials and the strategy and the external environment.
So what does this all mean for you as you think about this company, DH, and maybe the government services sector more broadly?
Well, here's a final thought based on what we heard. Consider the long-term implications of that tension management described. You've got the administration's stated goals, efficiency, consolidation, speed, running up against the short-term reality of increased oversight and maybe fewer resources causing delays. How is that paradox going to ultimately reshape the timeline, the process, how government contracts get awarded and managed in the coming years?
It's a really crucial dynamic to watch, isn't it? How that resolves itself will impact everyone in this space.
Definitely something to keep an eye on. Thanks for joining us for this deep dive. And remember, one last time, everything we discussed today was an analysis of publicly available information from a specific earnings call transcript. It is absolutely, unequivocally not financial advice.
Please do your own research.
We encourage you to look into the source material yourself if you want to go even deeper. Thanks for listening.